Sorry to condo investors. Ottawa rocks. That's from a Leaf fan. Farewell golf season. All this and more on the truth about real estate investing for Canadians. Greetings, investors. My name is Robin Cito, landlord of 40 plus different properties through my career since 2005, realtor since 2010, and together with my team at iWin Real Estate, we have helped investors transact on close to a half a billion investment properties. Among my clients are 45 millionaires and multi-millionaires and counting. We help them achieve this through education and coaching. And I get paid because we're realtors. Anyways, that was all in Ontario, but until around last year, the writing's been in neon letters on the wall. Cash flow is no longer an option for the everyday investor. Governments of all levels let it be known we are not welcome here, and the opportunity for better cash flow, diversification in the USA, and avoiding the LTV or RTB if you're in BC was available along with scalable mortgages in the USA. Thanks to a lot of technology advancements. It's crazy how technology is making life better. Anyways, sadly, we're slowing down what's slowing down many Canadians investing in the South is they're holding pre and new construction condos. Some of them are houses as well, but yeah, they're all pretty tough. The options aren't great for those who are holding those types of properties, especially those who've lost their jobs. I had a new condo investor share with me this past weekend. He owns a beautiful 300 square foot brand new condo with the lake view. The property's in the GTA and it's south of the lake shore and has beautiful views. He paid $900,000 for it, which sounds about right. And it only rents for $2,400. It's outside of downtown, so apparently the rents aren't as good. After multiple attempts to rent it out for higher prices, his original asking price was over $2,800, I believe he said. And then cut down to 2,400 is what he's getting now. So after hard costs, which means mortgage, taxes, insurance, and condo fees, of course, he is negative $2,000 a month. And that's before you factor in any sort of vacancy, leasing fees, bad debt, repairs and maintenance. So in reality, his negative cash flow is significantly much more. Now, not all Canadian real estates are bad. I hope the show is the truth about real estate investing. However, it's harder to find those markets and investors who can execute a quality investment deal. If you listen to Andrew Hines' final podcast, I recommend that you do. I'm experiencing the same thing he is. I've invited gurus onto my show, and it's crickets. Not all of them, but for many of them, it's crickets. Only to find out later through the news or the grapevine that some of them are having financial troubles. Even though some of those gurus out there, I'm friends with them on social media. Uh, anyways, they're still out there raising capital for their projects, or they're borrowing hard money loans, aka private borrowing, private lending. They're selling courses and coaching, etc. They're running meetups and speed networking, whatever's, and they're turning down exposure on my podcast. This is the Truth About Real Estate Investing show. So, what you 17 listeners, faithful listeners, thank you for all of you as well. What you may not know is that before we do record, I do ask guests if they're okay to discuss losses, both what's in the news and not in the news. I also do reference checks on guests of the show by contacting people unsolicited. Like they're not providing me reference checks. I actually don't even ask for reference checks. I've been around long enough to know who does business with who. If nothing else, I know people in pretty much every real estate market for investment. I can just simply dial one of them up and they'll take my call or return my call. Anyways, so I simply contact people in the same markets as them or people I know have done business with them, either as a lender, borrower, as a contractor, what have you. And anyone who's engaged with business with them and ask them for a reference check as they are potential guests of my show. Most people know how protective I am of my reputation and of my 17 listeners. There's no reason to put you in front of harm. That's not what the show is about. If you are out there reference checking folks, like a coach or you want to invest with somebody, whatever, feel free to check them out. Check out if they've been on the show before. Now, being on this show is not an endorsement by any means, nor is it a condemnation if they haven't been on the show. We are not perfect. I am not perfect. I've lost money too. Anyone who says they haven't lost money is lying to you. And there are those people out there who coach and raise money and say they've never lost money. Anyways, we've actually added into show notes of some past guests of the show who are being sued or are bankrupt or going bankrupt or in the news. So we put those links in the show notes. and I digress. So if you know good people that you think should be on the show, encourage them to come on the show or reach out and recommend them yourself. I'm always happy to interview good people who are good investors who know how to protect their clients' best interests. If nothing else, I really enjoy shining a light on the good people in this industry in order to if nothing else, we can crowd out the bad operators. Speaking of good people, who has nothing to sell you today, it's always fun to have a non-real estate professional on the show. Today's guest is my good friend and past client, Adam Johnson. Ready for it? He's got a lot of letters behind his name. CPA, CA, those are the accounting designations. This is one that's not so common. CBV for Chartered Business Valuator and CFA Chartered Financial Analyst. So Adam, who at the time was my youngest client at the time, and we talked about that, he didn't have as many letters behind his name at that time, and he's not your average CPA. So as mentioned, he is a Chartered Business Valuator and Chartered Financial Analyst, making him one of less than 100 people in Canada with all three designations. He even ranked #1 in the country on his Chartered Business Valuator exam. But what really sets him apart is his hands-on experience with one of Canada's biggest investment banks, did I say that right? Banks, where he analyzed stocks and worked directly with equity traders. So these are people who make money dealing with stocks, big investor money, which prepared him nicely for a long career in business valuations. Now, Adam's expanding his investing to the US after Ontario deals no longer made sense. And he's the founder of Synthesis Valuations. He opened that business quite a while ago, and he'll detail that in the interview, where he provides top-tier valuation reports for everything from mergers to shareholder disputes. Note, we recorded this episode on September 17th, so that was before the most recent pair of hurricanes, Helene and Milton, that devastated Florida. Helene was the deadliest hurricane to make landfall in Katrina since 2005. The combined damage from the two hurricanes is $100 billion. That's $50 billion each. For context, that major storm that passed through Toronto in the summer it caused $1 billion in damage. So between these two hurricanes, that's 100 times more damage. My thoughts and well wishes are with Florida. I've obviously sourced all my resources, so I have links in the show notes on the article to back up the $50 billion damages per hurricane. For your business valuation needs, Adam's website is synthesisvaluations.com. Now, what's someone with so much stock and business valuation skill doing, being so overweighted in real estate investing? Let's ask Adam. Please enjoy the show. Hi, Adam. What's keeping you busy these days?
Well, I think before I came out here, I was working on a couple of different valuation files for a few companies that I'm valuing, but also getting caught up on some news that I think actually is pertinent to many of your audience members who are real estate investors or looking to be real estate investors, because we're on a sort of interesting news day, recording this September 17th, where new inflation data just came in. And we also got the news about extending amortizations to 30 years for all first-time home buyers in Canada.
And raising the insurable limit.
Right, yes, for insured mortgages from $1 million to $1.5 million. So there's actually a couple of headlines I was digesting before I was on my way out here.
And then, from the context of someone who looks at the States, like $1.5 million. And because I say to friends all the time, who like talking about real estate, in a lot of nice cities in the States, you can buy a mansion for $1 million. You can buy a 4,000 square foot house for $1 million.
Or less than $1 million.
Or less than $1 million.
Yes.
But it's crazy. Everything's crazy. Actually, I just wanted to check what the bond prices were doing with the inflation rate. Yeah, just talk about the inflation rate.
So you can fact check me on the spot, but I believe inflation came in at 2%, which is the lowest that's been since early 2021, before inflation started to spike. A little bit softer than what I think most bank economists were expecting, or at least the average of bank economists. And I think that will be welcome news for anyone hoping that interest rates set by the Bank of Canada will continue to trend downward. Excuse me.
Yeah, it's interesting. The bond rate's actually up today. Bond rates are up today.
Oh, I am surprised to hear that.
They must have overcorrected the last few days. Yeah, 'cause the last few
Perhaps.
days they were down, and then it sort of
Yeah.
actually came up.
Well, I don't know how much of that would be influenced as well by sort of Canadian bond traders having to figure out what the Federal Reserve's going to do, because they have a big decision happening tomorrow as well. So that might have played into it as well.
And funny enough, the dollar's flat today, so it looks like the market looks like they kind of knew this was coming. Interesting. Good job. Well done. Good job, market. Now, having you on the show because you are a valuation expert. It's very few words to describe your actual impressive history, experience level. Tell us a bit about yourself.
Sure. So I run a consulting and advisory firm called Synthesis Valuations. And quite simply, I am in the business of valuing businesses. You can think about it in simple terms like that. As real estate investors, I think we're all familiar with real estate appraisers and the work that they do. You want to go buy a house or evaluate a property, they give you an appraisal report, they look at comparables. Really, valuing a business is sort of built on a lot of the same principles. But the key difference is there's a lot less uniformity among how businesses look, right? I mean, a pharmaceutical company with an early stage drug is going to be valued differently than a manufacturing business, and it's going to be valued differently than, you know, a holding company with that portfolio of investments. And so as business valuators, we are trying to look at different data points and try to triangulate how much is something is worth when we're not in the context of a publicly traded stock and we don't have a good indicator of, you know, what someone would be willing to pay for a business or a piece of business.
Yeah, because we recently reconnected because my wife asked to refer you to a client of ours, and it was a very small business with not a lot of revenue. So I can't imagine it's an easy job.
Yeah, I mean, it's not easy. It's interesting, which is why I love doing it, but it's certainly not easy. But just some of the situations that you might see come across my desk, right? You've got transfers of businesses, maybe that small business that you were talking about, being handed down from one generation to the next generation. A tax accountant or a lawyer, maybe Cherry wants to execute some sort of tax plan to sort of be most tax efficient. The Canada Revenue Agency is going to want to understand what the fair market value of the shares of that company was at that point in time. Let's say you're a partner in a business, not publicly traded, and one shareholder or one partner wants to buy the other out. They may, on friendly terms, engage to retain someone like me, or there might actually be a contractual clause in their shareholders agreement saying that they need to retain someone like me in the event that one is going to buy out the other's interests. Divorces, these get messy, but where you have a family business, a privately owned business in many cases, that forms part of the family assets or the family property that needs to be divided for equalization, you will often, see someone like me get involved to sort of establish what the fair market value is for that purpose. And then lastly, this is probably more applicable to public companies, but there are many cases just for accounting, financial reporting requirements where a company who maybe has a subsidiary company or has completed a business acquisition of some sort, and they need to look at the fair value of the assets they have acquired. I do a lot of work in that space as well.
I'm a geek, so I like this hearing all this stuff. And just for the listener's benefit, like your background is you have your chartered, your CA. Actually, you have other designations, don't you?
There's a few letters, yeah.
Yeah, you have a CFA as well. So you've spent a career in school. CBV, what's the acronym for?
So let's just run through those quickly. Okay. So I'm a chartered professional accountant, which I'm sure many of the listeners on this podcast are familiar with what CPAs do.
An accountant, yeah.
An accountant, right? That said, I don't do typical public accounting work, right? I don't even do my own tax returns, so don't ask me for tax advice. Plus, you have Cherry for that. I then sort of moved on to become a chartered financial analyst, or CFA. And that's the designation that you would probably most commonly see used in the world of investment analysis. And by that, I mean making decisions to buy or sell stocks or bonds. Most equity research analysts working on Bay Street, investment analysts, Wall Street, investment analysts working for our pension funds. A lot of them would have that designation. And that's actually what I did for a couple of years, was work on a team that put buy, sell, and hold recommendations on our universe of stocks that we covered. And then lastly, the CBV that you asked about, that stands for Chartered Business Valuator, which really I would argue is sort of the core professional credential that's widely recognized by Canadian courts, Canadian accounting firms, and the CRA when it comes to some sort of business interest that needs to be valued in sort of a notional or theoretical setting.
And you worked at one of Canada's largest investment banks, so you know investing in valuation quite well.
I like to think I do, yes.
Right. And then how did you decide to allocate your investment portfolio? All stocks, all real estate?
So I guess you could say I sort of believe in an all of the above strategy when it comes to what our portfolio should look like. I mean, I have stocks and equity ETFs. I have bond ETFs. I have actually some private credit that Wealthsimple, I think it is, offers. All of the things you would typically see in a TFSA or an RSP or just non-registered investments. But I guess sort of early on in my career, and we're talking 15 years ago, I went down the real estate road. And if we looked at my balance sheet right now, one could probably argue that I'm a little bit overweight real estate, perhaps a lot overweight real estate. But I'm sure on this podcast that's not gonna cause too many eyebrows to be raised.
I'll also add to that, of the people I know who did really well financially with their investment portfolios, it's overwhelmingly real estate people. Maybe this is just who I'm surrounded by. But
yeah. No, I mean, I think I was biased towards real estate, right? Maybe even as early as university. I read all the books that most real estate investors go on to read. I read Rich Dad, Poor Dad. I read Don Campbell's book for Canadians specifically. And so I think I was always my mindset was skewed towards owning some rental properties eventually. But then I graduated in 2009, which was an interesting time for real estate. And obviously real estate fell very much out of favor after we were in the midst of a financial crisis and the U.S. housing market had just suffered its most catastrophic losses, quite possibly ever. I'm not sure.
I'm sure it's up there.
Yeah. Yeah. And so, when I was fresh out of university, I had the opportunity to buy a condo downtown Toronto. And really, it was just sort of an easy decision for me. When I looked at the cost to rent versus the cost to own, even as my primary residence, we're not even talking rental properties at this point in time, it was about the same. So would I rather rent for that price, or would I rather own for that price and start deleveraging over time and paying off my mortgage over time? I chose to own. And that's sort of where it all started.
Fascinating. There's so many questions I want to ask because, again, we've qualified you as an expert in valuation.
I feel like I'm in a witness stand in court now.
Yes, you are. This is a contentious relationship.
I mean, that's what they say when they qualify people as experts at court.
Would you do the same deal today?
The same deal to purchase that first condo?
But at today's prices, though.
At today's prices...
September 17th, 2024.
No. Or at least it would be very difficult to do. The math looks very different, right? I mean, I still own that condo, so let's actually just take it as an example because it's real numbers. I mean, I paid $290,000 for that condo in 2009. I think the last bank appraisal that I did in 2021, when I did a refi on it, came in at $690. I think when I bought it in 2009, sort of the prevailing rent or maybe the cost to own would have been something like $1,500 or $1,600 a month. And right now, the rent on it is $2,800. And that's what the current residents are paying, which is actually at market because that just turned over in April. But I don't have a calculator in front of me, but I think we can conclusively say that to buy a condo for $690,000, really using any sort of leverage or any sort of debt, you would have to put a lot of equity into that to make that work.
Even if you had the equity, though, would you do the deal? It doesn't make sense financially.
No, I mean, if we talk about, we can debate about whether we should be using the term cap rate for a small Toronto condo, but for your listeners, cap rate, just meaning like, the net operating income I, as the property owner, am taking from that property, dividing it by the value. Let's do the math right now.
Oh, I already have your rent yield at about 4.9.
So 2,800, right. But you need to deduct condo fees too, right?
I've done similar numbers already.
So
if it's conservative, your cap rate's around 2.5.
Yeah, that sounds, I was going to say between 2 and 3. Yeah. That sounds about right to me. So I'm not going to dispute that. That sounds in the ballpark. So why would you buy a 2.5% cap rate condo in Toronto when you could literally buy a GIC right now or a government bond that yields more than that? There's really only one logical reason you would do that, which is if you really feel strongly about using that condo as a hedge against future price inflation, which would have to be driven by a pretty strong belief that prices are going to continue to appreciate in Toronto after they've just had probably their best run, up until about 2022 in a very long period of time. So yes, there's a good mathematical argument that I should just actually sell that condo and move on, put my equity elsewhere. I decided to keep it really as a matter of convenience, I would say, right? It's there. It had 0 vacancy turnover, 0 days of vacancy when it turned over in April. I can walk to it if an issue comes up, so I can actually self-manage that one. But if we were just looking at raw numbers, it would not be a great return on investment.
So talk about the States. You're investing in the States now. Why the decision to do all that? You do quite well.
Sure.
You're comfortable living in Toronto?
Yeah. No, okay. So I guess, what did I buy in the States? And I guess I'm going to back up here again another 12 or 15 years. So I bought that first condo in Toronto. A couple of years later, it was actually right before I was working in that job analyzing stocks, renewable energy stocks. I was subscribing to, we had these things called magazines back then. They were like hard copied magazines. And
You're still a young guy too. We're talking about way back when we had magazines.
No, but so I subscribed to this magazine called Canadian Real Estate Wealth Magazine.
Oh, yeah.
And I read this article about this guy who dubbed himself Mr. Hamilton.
A jerk.
And he was sort of explaining at that time, and we're talking fall of 2011, I think it was,
good time to
the investment thesis for Hamilton. And I was actually finally at that point ready to buy, a true rental property, not just one that I lived in, but one that I was going to buy and rent out purely as an investment. And I made a cold call to Mr. Hamilton. We went out one Saturday, I think, looked at 3 listings in Hamilton, and that same weekend, I put in an offer to buy one of them. So that was in 2000. That closed in January 2012.
Remember what we paid for it? I should
$201,000 for a semi-detached house in a, modest but reasonably nice cul-de-sac
Yeah.
on the mountain.
Yeah, Hamilton Mountain, yeah.
I still have that property as well. And so that's sort of what gave rise to investing in the US was I didn't really do a whole lot in Canada between that purchase in 2012 onward, in part because
Oh, at least you did well. So.
I did well. And I was also really at that point,
Because that house is 600,000 today?
probably something like that.
It's
Yeah.
a nice triple. Yeah, nice
Yeah, exactly. I had been, thinking about starting my own business, which I did in 2016.
I remember that conversation.
Right. And so at that point, my focus became on making sure I had enough liquidity to start a business, which is at odds with real estate investing. But what I will say about that nice house in Hamilton is that it's a gift that keeps on giving. I mean, I refinanced it in 2015 to take a little bit of equity out, which gave me a bit of liquidity buffer to actually start that business, right? Sort of allowed me to take that risk.
Yeah, your investment property financed your new business.
In a way, yeah. And then if we fast forward to 2020, when the pandemic started, that's sort of when the idea of actually investing in the States took hold for a couple of reasons. One, like everyone, I was stuck at home in what I guess was a new-ish primary residence downtown Toronto, and I had turned that first condo into a rental. And I found myself, spending an inordinate amount of time on Zillow, searching through listings in different markets, different cities, sort of as like a virtual escape when it was really difficult to travel, right? Or pretty much impossible to travel. And then that's sort of when the wheels started turning. I could very quickly just look at certain rent to price ratios in different markets. And then I thought about it, and to your point about cap rate that we were talking about earlier, at this point, that first condo in Toronto was close to being paid off or almost paid off. The Hamilton Mountain house had a pretty modest mortgage even after the refinancing. And so I had access to quite a bit of equity on which my return was really not that great, right? Like just on a pure cash on market value of equity perspective. And so I thought more seriously about actually taking some of that equity and putting it south of the border. And it wasn't really that much of a leap for me because, at this point I had been used to managing a property manager, that is, in Hamilton. I'd learned a few things about, the challenges that come along with owning real estate as a direct investment. And really, to me, managing that manager from 1,000 miles away wasn't really that much more daunting than managing the manager in Hamilton, other than understanding and giving myself a good understanding of the cross-border nuances between Canada and US, which there are several.
Is it that hard? You are an accountant.
No, I mean, it took me some time to get there, but yes, I was able to get to the point of comfort to actually take the leap. So in June of 2021, I bought my first property in the US, which was a beautiful 2006 build, 1,827 square foot, 3-bed, 2-bath house in a pretty nice subdivision. Didn't need a lot of work in Fort Worth, Texas.
Oh, Fort Worth. Okay. So Dallas's neighbor, yeah.
Yeah, it's sort of the forgotten sister city. It was a little bit, obviously 2021 was a super hot market in most places in North America just because of where rates were. I mean, if you were an American, you could get a 30-year fixed mortgage for 2 or 3%. Prices were shooting up. I think I actually bid on 7 houses before I bought this one.
Oh, is that hot, eh?
And Fort Worth was a little bit cooler than Dallas.
Interesting.
And so still got the numbers to work, but I pulled the trigger on that, and it gave me relatively few headaches. And so I kept going with a couple of more.
Can I ask you how much you paid for the house?
So that was $292,000 US.
Okay, just to repeat that for listeners' benefit, 2006 build, 1,827 square foot, 3-bedroom, 2-bathroom. Now, the thing about American houses, their bathrooms are big.
Yeah, they are. I think this had like a nice soaker tub in it.
Right. And double sink?
Yes,
Yeah, so it's a 6-piece bathroom.
I believe so, yes.
Yeah. I actually was clarifying that with my home inspector the other day, like, oh yeah, I have a 6-piece bathroom in my rental property. I don't have that in any of my houses.
Yeah, no, it's not something you're going to see here, right? But, I mean, land prices in Fort Worth are also a lot lower than they are, given that you've got this geographically unconstrained land mass on which you can build, whereas we have, you know, natural barriers here, right? We have the greenbelt, we have the lake. We have to build up, obviously, and not out in the same way that they do in the Dallas-Fort Worth Metroplex.
Yeah, can I ask what your rent is?
So it actually just turned over as well as of August 29th, but I believe it was at $2,300. So the same tenants actually stayed there for 3 years.
Good.
Yeah. And I looked at the move out inspection photos, took really good care of it.
Fantastic.
And so it started out lower than that, like it wasn't 2,300 3 years ago, but we did gradually get it up there.
And then was it pretty effortless? Pretty painless?
That one was pretty effortless, right? So it does, I mean, it's part of an HOA. Some HOAs are more annoying than others, as I've found.
Right. So
I mean,
condominium board? Yeah.
Yeah, exactly. So it's still like it's a detached house, but you're still subject to sort of the rules around how to keep your lawn looking, what type of shrub you can have. I don't think this HOA, the rules are quite so stringent. There is another HOA that I dealt with that is much more of a pain to deal with in that respect, but there's an easy workaround for that, which is just don't buy a house that's part of an HOA. But this one was, of the 4 U.S. properties that I have, this has been the most headache-free, for sure.
Very nice. Yeah, we've had issues in Hamilton, for example, with condos. I don't know if us investors are being just targeted, but they were just heavy-handed. Like, just how immediately the enforcement notes came for like putting your recycling and garbage bins back.
Yes.
Right. Just it seemed heavy-handed. Anyways, so the U.S. investment's been going well?
Yeah, I mean, I've done 4 now. They all are very different. Well, 2 of them are the same, but I'd characterize them as being different. And it's sort of, with each one, I've embraced a little bit more risk, and we can sort of talk about the consequences of some of that risk. But,
let's talk about it. Because one of them is in Florida, is not?
2 are in Florida. So let's back up and get to the journey of how I ended up in Florida. So
I love it.
After, for that very first one, I was sort of just, in my mind, dipping my toes in, right?
And done quite well.
Sorry?
Done quite well. 2,300 rent on a 292 property.
Yeah, it was a solid buy. I didn't get a screaming deal on it. Like, I think the bank appraisal. Right? Yeah, I had to fight for it. I think the bank appraisal came in at $295, so maybe I walked in with $2,500 in built-in equity or something. But that was dipping my toes in, right? I wanted to really try this experiment. I put in very little of my own money because I used equity from a HELOC. I think on the Hamilton Mountain House is my down payment, 30%, nice. And got 70% loan to value from a U.S. lender. And so it was really a 100% debt financed deal. And after it went okay, maybe about 6 months later, I decided to dip my toes in again, stuck with the same market. This time it was a little bit more of a risky buy in that it came from a wholesaler, actually. But again, it was a similar story, different city, Denton, Texas, which is a little bit more to the northwest. home to University of North Texas. That was a 2,300 square foot, 4-bed, 2.5 bath, built in 2007. It was actually a little bit, I'm going to say, less nice on the inside than the first one. Just, I think it had been an investment property for longer. The owner, I think, was just a tired landlord.
Adam, can you bring up Denton, Texas on the screen? I'm a visual person.
Yeah, sure.
It's troublesome we have two Adams in here.
Denton. Yeah.
Denton?
Yeah, just like it sounds.
Texas. For the listeners' benefit, we do have a screen and we post this on YouTube as well. So shout out to our YouTube channel, Truth About Real Estate Investing. Oh wow, that's pretty. Holy cow, that looks nice. Can you click on the map, Adam? Not even airport. Wow,
Yeah.
what is this building here?
I actually,
Wait, have you been there?
I've been to the house. I haven't been to this building.
It was. Wow.
So the key to this house, the reason for the buy was the school district it was located in Denton, and
Yeah, so you're greater Dallas-Fort Worth.
it's still a commutable distance to DFW, but to the north.
Yeah.
But it is sort of a city, and it's a small city in its own right. But Americans are all about their school districts, right? And so I did actually sort of vet this and research this and talk to a couple of people that this was a quite desirable school district, as was the first one, actually.
Interesting. Yeah, because I was looking north as well, like McKinney and up to Sherman as well.
Right. So I went to Sherman last year on a property tour where a company was sort of marketing new builds. But yeah, I've never. Sherman is? Depends what you're buying, I guess.
Depends what you're buying. Like, just for my target was to stay under 300. Like,
right.
The more under 300, the better. But it's really hard to find a new build around like under that.
Oh yeah, no, I agree with that. And so this second one in Denton I had to go a little bit above 300 because in that second 6 months of 2021, prices continued to go up. So I think that one was about 316 was what I paid for that one.
Mm-hmm. And what's it renting for?
It is currently renting for 2,200, which is actually down a little bit from the first one. And I think it was really a time of year effect. Unfortunately, the previous tenants decided to sort of leave late fall. I sort of missed a good chunk of the rental market, and so I was willing to concede a little bit to get somebody in there last January. But still, compared when you take that rent to price ratio, compare it to what we see
In Canada.
up here, it's a different story. That said, I will say this about Texas. I do think those were two decent buys. I like Texas, or actually I shouldn't say Texas as a whole. Dallas-Fort Worth attracted me for a number of reasons, right?
Oh, yeah.
Like the rent to price ratio we talked about.
It's the number 2 choice of REITs for markets.
Right. Yeah. I mean,
It's a pretty safe
Invitation
decision.
Homes, which owns 84,000 houses in the U.S., I actually was looking at this morning out of curiosity. I looked at their data for the last 8 quarters. They were net buyers in the Dallas area, so that gave me some peace of mind. Diversified economy. Like when I went to Texas, I did not want a Houston, which to me just seemed a little bit too exposed to oil and gas, and also a bit more exposed to hurricanes as well.
Mm-hmm.
DFW is a pretty.
We're gonna get to Florida.
We'll get to Florida, right? For that reason. DFW, its economy is a bit more diversified, right? Like, I think it's something like 20 of the Fortune 500 companies are headquartered somewhere in the Metroplex, and it's across industries, right? You've got American Airlines, Southwest Airlines, AT&T, I believe
Texas
there, Texas Instruments, McKesson, I believe, is there, if I'm not mistaken. And so it made a lot more sense. But the one thing,
Oh, sorry, just add to that. Outside of Toronto, you won't find that in Canada,
right, in terms
that
of
many-
economic diversification.
or even just that number of Fortune 500 head offices.
Oh yeah, 100%. And actually, if we're talking about Toronto as a financial capital, one interesting read I had in the Wall Street Journal recently is that JP Morgan Chase now employs more people in the state of Texas than it does in the state of New York.
Interesting.
They've moved another campus or opening another campus there. And so DFW is actually sort of becoming a regional financial hub in its own right. So those are all the things I like about DFW.
So you're using your valuation skills to make sure you have a good investment.
Yeah, I think that's more actually just real
Don't say
estate
common
fundamental
sense.
common sense.
Okay.
Yeah, I don't think that takes a valuator to figure that part out. Where the valuator cab comes in would be the thing I don't like about Texas, and I'm sure you found this after owning a place in San Antonio, is the property taxes.
Yeah, mine's like 5,000. What's
Yeah.
yours?
So on that $292,000 house in Fort Worth, the 2024 tax bill was $8,400. Because one other thing that I found, and for context, that is more than I pay on my primary residence in Toronto, which I paid more than $1 million for last year. And what I found is that compared to MPAC in Ontario, where I think we actually take it for granted and we get a little bit lucky, they take a very long time for tax appraised values to catch up to market values, right?
Yeah, forever.
The Tarrant County property assessor and tax collector and the Denton County property assessor and tax collector, I can say with some hindsight and certainty, are very fast to recalibrate those two things. So
Seems like it sounds like it's annual.
yeah. And so if they see that the property has changed hands for $292,000 in 2021, they're not giving you the benefit of the doubt that it was, last MPAC assessed in 2020 for something well below that. They're going to actually look at the property records, see that transaction took place, and market to that. And so that is unfortunately just one of the things about Texas as a whole, and certain other states.
Well, wait, aren't you going to fight it? The prices have come down, have they not?
I could probably protest that one in Tarrant County if I really wanted to. The Denton County one, I think, is probably closer to being right, in my opinion, because I think the Tarrant County, the Fort Worth one, I think was tax appraised for $370, which I don't think it would sell for right now. I think it would be more like $350, $345. So I don't know what. Do the math. $345 over $370 times $8,400. Is that worth my time fighting some tax assessor? Maybe, maybe not.
Depends how much time you have.
I'll get to it.
So Cher's actually going to fight on my behalf, for mine.
Sorry?
Cher's going to fight on.
Yeah, I mean, if you've got somebody to do it for you, then I would say, sure, go do it for me. But I make my living selling my time too. So
for a lot of money.
Well, I know what a unit of my time is worth, and I haven't gotten around to fighting my Tarrant County property taxes.
Maybe just poke your PM and see if they provide that service.
I don't believe they do. I have a pretty bare bones PM in DFW, if I'm being honest. I mean, they do eviction protection. They've done a pretty decent job on the Fort Worth one. The Denton one, I just say, as I said, about an HOA that's a bit more aggressive. That would be the one in Denton. So I have to get them sort of more involved to remind the residents to bring in the trash bins, just like you said. And, I think they have somebody sort of driving around the streets every day just to take a look at things like that. So the Denton one's more annoying overall than the Fort Worth one, even though was probably... Might have actually been, it would have been a lower price per square foot to buy. So that was late 2021.
Oh, sorry, I just want to give some context. Actually, your prices are still going up, even though you had to fight for your property. Interesting.
I mean,
Fantastic.
the party was still going on when I got in 2021, right? I don't think they really peaked until mid 2022 when central bank interest rates and so both sides of the border started going up. So in that sense, time did a little bit of work for me in probably the 6 to 12 months between when I bought those and when sort of the peak happened and prices started retreating a little bit.
Right, but you're up like 60 grand on a 292 property.
Yeah, and it didn't take that long to get there now.
You must be pretty happy then.
I was pretty happy with that one, yeah.
But-
You know, less happy with the Dent one, but very happy with the first one. Because it was still when things were going up. And I sort of knew that I could see, right, after losing out on 7 properties before that, but also be trying to be careful and prudent not to overpay, that the legs of the party probably still had a little bit more to go before the music stopped, so to speak.
Is it the same property manager between the 2 properties?
Yes.
So that's nice. At least you can consolidate that way. It's one conversation rather than 2.
Agreed. And obviously being in a big metro area like that, you've got access to a lot of property managers should you feel the need to make a change. And that was one thing I kept in mind as well when I was looking at where to buy first, was I wanted access to a slew of property managers, which in a huge metro area like that is obviously not an issue.
That's one of the big differences between the States and Canada is property management companies in the States actually have resale values. Actually, you're the perfect person to comment on that. Because that's what I hear. Based on what I'm seeing, like I hear about private equity firms putting money into property management companies in the States. I don't know if I'll see that here in Canada ever. Not anyone I know in the community.
Oh, you just mean in terms of like the significance of property management as a sort of sub-industry in the United States?
It just seems to be a viable business versus it's just you don't really see anyone scale here locally because there's not enough cash flow and it's too difficult to tenant relationship, business relationship with your customer.
Yeah, no, as a business valuator, I would actually say that a property management business is pretty challenging, right? You've got, unless you can get that growth, that unit growth, it is all about scale, right? You've got razor thin margins. And so I think to do it well in the 21st century, the firms that are able to be competitive in pricing, right? Having a pretty good technology platform, that's like a given, that's table stakes, and just figuring out how to sort of deploy a limited number of human resources across a broad geography. So in fact, it's a different company that I use in Texas and in Florida, 2 different companies, but both of them operate in several metro areas. And you might be talking to somebody on, say, an accounting question or a property maintenance question, and if they're just coordinating something behind the scenes, they might not even be in that same metro, which has its pros and its cons. But I understand that having sort of looked under the hood and seeing financial statements of a property management company and also just using some commercial common sense, it is a very difficult business to make money in. And you don't really get to the point of profitability until you get hundreds, if not thousands, of units.
Do you know how many houses under management your property management company has? I know it's not yours, but the one that you're...
Yeah, no. I'd actually be curious to look that up. I mean, I know the one in Texas probably does at least 1,000. And
That's a good number. Just in Texas? Are they just in Texas?
No, I'm saying like they'd have to do at least 1,000 across a few metro areas. I don't know how many they have in Dallas-Fort Worth. Hundreds in Dallas-Fort Worth for sure. I don't know whether they'd cross that threshold just in Dallas-Fort Worth. And then the Florida company, I was actually down there last week to meet the maintenance manager and also sort of turn it into a, somewhat of a time away for fun. her team had just in the Cape Coral Fort Myers area 300 herself, and I think she had a counterpart who probably did another 200, so I think they had about 500, which makes me think this company in Dallas Fort Worth, I would not be surprised if they got well over 1,000 in Dallas Fort Worth.
Right. This is all interesting because we haven't actually talked about this off camera. So this is all I'm learning here too, and hopefully the listeners getting benefit from this as well. The smallest property manager that we'll use at Share is 3,000 houses in that city.
Okay.
Yeah. So when we're talking about property manager, we're talking about different scales and contexts. So a PM company with 3,000 houses under management in that city is probably worth something, right?
Oh, as a business, yeah. I mean, if you've scaled to having that many, let's call them contracts, because that's, I guess, really what they are, month-to-month contracts.
Recurring income contracts.
Yeah, we in business valuation speak, if we were looking through this, or at this through the lens of accounting standards and a business combination, we probably say that there is some commercial goodwill associated with those contracts or those customer relationships. So I agree. I mean, it's different than just one person who manages, a dozen or 2 dozen units on their own for individual investors, which are all, are all over the place. But I agree with you that there are a lot of, I was sort of overwhelmed by choice when I was interviewing property managers in DFW because there were just a lot.
Interesting. And then how was that? Were they like wanting your business, or were they like?
Yeah, I mean,
because here it's so different.
No, they were like, the one company had a full-time business development manager whose job it was to bring in business. So yeah, they were aggressive in wanting clients, right?
Yeah, because you're a Hamilton property manager. Do they have such roles and divisions between responsibilities?
Yeah, no, it was a full, and he pitched himself as, I'm an investor too, right? Like, he talked about his units that he owned and how they manage him. So it was very much the, at least, perception that they were trying to sell of, we're investors too, we're not just managers.
But wow, they had a person just in business development.
Oh yeah.
Again, I'd have never seen this in a local.
No, I mean, this team, yeah, would it surprise me if they had 3,000 units under management, like the sort of threshold you look for? No, it wouldn't, because to support that sort of headcount, you would need to be there, I think.
But even your Florida PM, 300 houses under management?
Yeah.
Unheard of.
Well, and that's in a relatively smaller metro area too, right? That's in Cape Coral, Fort Myers, which is somewhere, I think, between 500,000 and 1 million people, depending on where you set the boundaries.
Is it that many? I didn't even know that. Fort Myers. Yeah. Okay. You want to talk about Florida?
Yeah, let's talk about Florida. So, let's sort of fast forward to 2022.
Okay. So after the Texas
after Denton, which was December 2021, I was having a little bit of fun with this, and it was Omicron happened.
Is that right?
That would be just Fort Myers. If you if you Google Cape Coral Fort Myers MSA.
Okay. So Fort Myers is 96,000 population as of 2022.
I thought it was, that sounds low to me, but again,
because you're all looking at tourists.
Are we gonna find the population
of? So it looks like 760,000.
Yes, that sounds about right to me.
Yeah. That's actually pretty big.
It's grown a lot over the years, which I think has been a help and a hindrance at the same time. But if we fast forward to 2022, I had these 2 single-family rentals. They were still, even at those prices, still fairly hard to cash flow, just because I was basically buying them with 100% debt, right? So that was more of a capital structure
issue. And we're not advising anyone to do
no,
these things.
No, that was more of a capital structure issue than that they would have cash flowed if I had actually
Had
put
some
the
cash.
30% down in cash. Yes. So I was sort of
Actually,
with each-
let's dig into that.
Yeah.
So why would you do that then?
Why would I do that? Okay, so in business valuations, we have this concept called a firm's optimal capital structure, right?
I like this.
Well, no,
It's
I mean,
never been brought up on this show.
Well, it's like I'll take myself back to fourth year strategy class in university where we had to play this computer simulation game, and one of the things we had to control as the fictitious executive management team was how much debt the company was taking on. And there's sort of this concept in financial theory, right, that there's sort of a graph that's like a vertical semicircle, in that there's benefit to adding debt to a business to a certain extent if you're trying to maximize value for shareholders, right? Debt
And you're the shareholder in this case.
yeah, I was shareholder of my own little real estate portfolio. But even if we apply that principle to business, debt is cheaper, right? In a theoretical sense, it is, quote, cheaper to borrow from the bank than it is to get somebody to invest equity in a business, typically because equity comes with a higher risk, right? The bank would get repaid first in the event that a business or a property goes belly up, and then investors are left holding whatever's left over.
Mm-hmm.
So equity investors typically demand a higher rate of return than a debt lender would.
Mm-hmm.
So you've got that element. You've got the fact that interest on debt for a business or for a rental property is tax deductible.
Mm-hmm.
So that makes the debt even cheaper. And as long as you can, use debt as a practical tool without using too much of it, there's sort of an optimal point where a business can service its debt, use that capital to grow, but not overburden itself with too much debt such that, making debt service payments comes at the expense of investing into growth projects or anything else.
Right.
And so when I
Sorry, just pause you there.
Mm-hmm.
What you just explained there is how pretty much all of our clients got ahead and made millions or multi-millions in real estate. And at the same time, there's this current group of investors who went well past that. They weren't borrowing cheap money from the bank. They were borrowing money from private individuals, along with lender fees and much higher interest rates.
No, exactly, right? There's a sweet spot where you can use it responsibly and enhance your returns as an equity investor.
Yeah, sweet spot, enhance your returns. Yes.
Yes, that's sort of what I think a textbook would say.
Okay.
And yes, I had used debt, right, 12 or 15 years before when I bought that house on the mountain or when I bought that condo in Toronto. Most of it was paid off. A good chunk of it was paid off. And so I had two properties, and I suspect your listeners may be familiar with the concept of loan to value, right?
They should if they've ever gotten a mortgage before.
Right. So right at this point, because of how much the Toronto condo from 2009 and the Hamilton house from 2012 had appreciated and the debt balance had gone down over those 12 or 15 years.
Because your tenant was paying your mortgage, essentially.
I now had a very low loan to value ratio on those two properties.
Okay. Your mortgage is very small in relation to the current value of the property.
Correct. Like they were probably worth around that time, let's say 1.3 million. And I probably had combined mortgages of 200,000, right? And so what's my loan to value on that? We can pull out of our phones.
I was just thinking
here.
your equity was 1.1. That's where my mind went.
Well, there's that too. But what was that equity doing at the time? It was sitting there. It was kind of idle. So what? My loan to value ratio would have been 15%. The business valuator in me knew that I could afford to, if I looked at the portfolio as a whole, and that's how I looked at it, as opposed to a property by property basis,
Yeah.
I could probably afford to lever up and
Right.
add some debt if I wanted to grow.
Right.
If I wanted just to sit back and maximize my quote cash flow, then I should have sold and bought properties in cash. But at this point, I'm still working. I hope to be working for a good number of years yet and have a decent amount of sort of career runway ahead of me, and wasn't necessarily relying on real estate for cash flow just yet. My mind sort of shifted more to how can I use this equity and grow.
Remind me again, how old were you when we met? 28?
I was 24 when we met
24?
in 2011.
Yeah.
So yeah.
Okay, now I remember now, because you held the record of our youngest client for quite some time.
I guess I was knocked off my throne at some point.
Yeah. Then Joe Costanza got you. I think it was 21 or 22.
Oh yeah, that would do it.
Yeah.
So yeah, 22 was the Toronto condo, and then I think 24 was the first true rental, and then a good sort of decade of nothing, and then 35 sort of realizing, well, this equity is sitting there. My business, my valuation business, was more at a point where I felt more comfortable adding a bit more financial risk to my real estate investing. Sort of lined up with the timing of when I started looking in the States, and that's sort of why I decided to add as much debt as I did.
Your journey to buying, at least for the States, actually, most of our clientele were very similar, very tiny mortgages on their principal residences. That's why they felt comfortable levering up. So just to provide the listener context on who, in reality, who the everyday investor really is. Almost nobody has cash. Almost everyone's using existing or creating new home equity lines to invest.
Yeah,
it's a responsible way to do it.
Yeah, no, but equity can be used as a powerful tool. If we think about that Hamilton Mountain house, it gave me liquidity when I needed to start a business, right? I at least had the foresight to refinance that before I quit my job to start my business.
When you had credit, yeah.
Yeah, when I had,
you had income to qualify.
When I was lendable. But then I dialed it back for several years while I was building that business, because believe it or not, building a business from scratch is actually kind of hard. And the first couple of years weren't necessarily as rosy as I would have liked. But then I got to a point where I felt comfortable adding more leverage to the real estate portfolio to grow that, let's call it $1.3 million of asset value, into something bigger, so that hopefully down the road that will provide a good piece of the foundation of the whole investment portfolio. When I go back to your original question of how do I choose to allocate my money, I'm now probably back to being overweight real estate compared to what most CFPs would probably tell me to do. But
what would a CFP tell you to do?
Well, I mean, I think a lot of CFPs think more in the world of build an 80-20 or 60-40 portfolio of equities and fixed income and call it a day, which isn't wrong. There's benefits to doing that. It's more liquid. It's less risky. It takes zero effort. But I also think, it's more volatile, and you can't use any leverage to do it that way.
Yeah, because I've mentioned it many times on the show, without leverage, real estate's not that great an investment.
No, and you've probably said this, but I'll just repeat it.
Yeah, please. You're the expert.
Right? I mean, sure. If the average price appreciation for houses long term is 2%, I'm just making up a number. I actually don't know what it is. 2%, and a 70-30 equity bond portfolio can get you 7%. You should go for the 7%, right? No, not necessarily. If you were buying a house in cash and earning 2% on that, like if you bought that $690,000 condo today with cash, then it probably doesn't make a great investment out of the gate. But if you're buying a property with some leverage, with let's say 25% down, I don't know what terms your U.S. borrowers are getting, or your Canadians borrowing in the U.S. are getting right now, but let's say 25 or 30% down, that 2% asset appreciation, so long as the property is cash flow break even, that 2% asset appreciation would therefore be 8% equity appreciation because you only put in 25%. Mm-hmm. So 2% times 4 is 8%. I think that's where a lot of people get mixed up reading articles in the financial press of, real estate isn't a great investment. Mm-hmm. Agreed, if you're adding no leverage to the mix, and you're just accepting that 2% price appreciation and getting no cash flow and. Mm-hmm.
Let me show you something. Adam, can you Google visual capitalist $100 asset? That should find me what I want. Visual capitalist. Yeah, that's the first one. And then keep searching for add $100 to it. $100. You need a dollar sign. So I love this chart. You already blocked 4 on this page alone. So this is a stock market. Scroll down, Adam.
Okay, so $100 becomes.
Well, I want to go to real estate because we're talking about real estate.
Yeah.
So, Case-Shiller Index says that from 1970 to 2023, the U.S. home prices have grown 5.5%. So the average house in the USA, average. So you and I don't like being average. We like to beat it. But even if we got an average return of 5.5% on the property, are you happy, Adam?
If I can use some leverage and turn that 5.5%,
which is what you're going to do,
something higher than yes,
100% leverage. But yeah,
yes.
Are you? Me, I would be ecstatic.
Yeah, no, I mean I am, but my time horizon in that is very long term, right? I mean, there's this expression I heard once, and I think it's worth repeating. You don't day trade real estate.
Oh, it'd be expensive.
Right.
Transaction costs.
And so when you're going to buy it, your time horizon has to be long enough to be worth it.
Mm-hmm. Well, the REITs, their time horizon is 10 years, right? The typical REIT is they'll sell the property after 10 years, but their time horizon is 10 years.
Yeah.
This ain't no flipping. This ain't no, not even 5. We're talking about 10 year, right? So the mentality of big money, big capitalist money, it's very different than the everyday investor. Other than you and I. 10 years is no problem for me.
No, and it's not for me either. I mean, so I'm now 37. So when I went back to deciding to build my portfolio again, I was 35, 34 when I bought that first place in Fort Worth. And again, I think that time's sort of going to hopefully do the heavy lifting for me on those properties in the same way that time did most of the heavy lifting for me in 2009 and 2012. Now, are my expectations as high as what they were in hindsight of how the condo in Toronto and the house on Hamilton Mountain performed from 2009 to 2024?
We had historic runs.
No. And so, I think people just need to be careful and calibrate their expectations for what's normal because,
that was not normal.
2009 to 2022. So basically, I'm going to call it most of my adult life. We saw interest rates move in only one direction, down. We saw real estate prices in Canada, and I guess after it recovered in the US, move in only one direction, which was up. And I think a lot of people sort of fell into the belief that that was going to sustain itself for the long run. And then when higher interest rates kicked in 2022, the party finally stopped. And the music finally stopped at the party, sort of like I feared that it would in 2021, but had a little bit of confidence, just sort of seeing all the buying activity, that it would continue for a little bit longer, and I could at least sort of get into a sound market without grossly overpaying, and then letting time do its work from that point forward.
Yeah. Because again, 53-year sample here, 5.5% price increases over that period every year, on average. Right.
Yeah, no, I'll take that.
I'll take that all day.
I'll take that. In part also because I think you've probably heard this analogy too, right? I can't remember where I read it, so apologies to whatever author I'm not attributing this to right now correctly. But if you think about real estate investing, right? How did this author describe it? You've got sort of it's like a 3-course meal. Cash flow is your appetizer.
Yeah.
Very hard, harder to get. Mortgage pay down, principal pay down, deleveraging, whatever you want to call it, is the main course. Just sort of the hold, buying and holding. The holding is generally what sets people up for success. And then appreciation is like the dessert. So if you can buy a property and get 5.5% appreciation over a 25, 30-year period while that property is being paid off, then
You're gonna get
after 25 or 30 years, you're going to be quite pleased with that decision. I even think back to the days of that Hamilton Mountain house. I looked at it more from the perspective of, and I didn't even though I worked in valuations at the time, I didn't sit down to actually calculate what my break-even rate of return would need to be. But if you put 20% down on a house and it breaks even for 30 years or whatever my amortization was at the time, and it pays for itself after those 30 years, even if the property doesn't appreciate, I have just increased my invested capital by 5 times, right?
Yeah, you're free and clean asset, yeah.
And then at that point, it's cash flowing. So, it was sort of a fairly easy decision with enough time horizon to look forward to.
Can we talk about Florida?
Let's
buy in Florida.
Well, we can talk about Florida, yeah. So I had avoided Florida for the longest time.
Why?
Like when I was picking my first U.S. real estate investment, I ended up in Texas, obviously. There were quite literally dozens, if not hundreds, of markets that you could choose from in the United States, right? That was actually the hardest part at the beginning, was like, oh, where am I going to start looking? Because that influences a lot of other things, like getting financing, property management, like we talked about.
Where to create your limited partnership.
Yeah, understanding market rents, whatever. I had avoided Florida because of when I bought my first U.S. property, which we now know was in the Dallas-Fort Worth Metroplex. I had considered Florida at that point, which was 2021. I mean, I had some familiarity from going to Florida most March breaks. My aunt and uncle were snowbirds who wintered in Southwest Florida. But I had, the phobia or the fear of a hurricane hitting my property. And, I believe that climate change is real, and the number of hurricanes that hit Florida, particularly the Gulf Coast, is real. And buying a property that was in the potential path of a hurricane was just a bit more risk than I wanted to stomach. And so that's sort of another reason why I started in Dallas-Fort Worth was it hadn't been quite as prone to extreme weather events in the last several years as the state of Florida had been. What was frustrating was, despite all of the reasons not to invest in Florida, people continue to move there, and the party's still sort of going on to a degree. I think I read projections recently from the state of Florida suggesting population growth of something like 320,000 people per year between 2024 and 2028. And so in a way, it was almost like this is a crowded trade, but I almost feel some sort of need to follow the crowd to a degree. Um, and part of it also too is for Canadian borrowers investing in the US, one thing you will find is that financing can be a bit of a roadblock, a bit of a challenge. And where I own my 2 properties in Florida, I was able to work with a great sort of small community bank who really did not care about the fact that I was a Canadian without a US credit score. And they've been fantastic to work with. So everything sort of lined up. And then I was also looking for a little just bit of diversification in terms of asset class, right? I mean, in Dallas Fort Worth, I had 2 fairly nice, excuse me, single family houses. Florida sort of gave me an opportunity to, I guess we can say, diversify into more true, multifamily in the form of a duplex and then also a 7-unit sort of small apartment building as well, which really was underwritten more like a commercial property. And a commercial property is actually arguably easier for a business valuator to value because it's just a function of net operating income and the prevailing cap rate. Though this was in 2022 when interest rates were already starting to move upwards, so trying to really nail down what the stabilized cap rate should be was a bit more of a challenge.
So were you there before Ian or after Ian?
Just before. So so this is my fears of investing in Florida came to fruition. And the 7-unit building would have closed in May. The duplex, which was sort of opportunistic and unexpected, but it was a listing that I found on Zillow managed by the same management company that was managing the 7-unit. And long story short, was being sold by a guy who had been, he was this is a great story. Because I went online, saw who the owner was, what their motivations were for selling, and it was a personal trainer and fitness coach who sold nutritional supplements, but I believe that it was concluded that some of his supplements included ingredients that were not totally 100% legal. And so in the words of the selling realtor when I called her up one Friday afternoon, oh yeah, they put him in the slammer, but he's out now, in case you're wondering. And I was like, well, I wasn't actually, but
That's an interesting disclosure, but yeah.
But we hammered out a deal that closed on September 15th of 2022, and Hurricane Ian, I believe, was maybe 10 to 14 days right after that.
Oh my God.
And at first, oh yeah, it was a slap in the face. And it looked like it was going to go north, hit closer to Tampa, but at the very last minute took a turn east, and Cape Coral, Fort Myers got the brunt of it, and I certainly was not spared in all of that. But I mean, it was a sort of validation of my concern in the first place of the risks associated with Florida.
So that last storm that hit Toronto and Mississauga, that was, I think it's approaching $1 billion in damages. Hurricane Ian, for context, was $113 billion worth of damage.
Yes, I believe it was the 3rd most expensive storm in U.S. history and the most expensive storm in Florida's history.
Huh.
Yeah.
And then how'd that affect your properties?
So both of them needed new roofs. That was the main damage. Like, neither of them are in flood zones, so that wasn't the issue. It was more wind than water was the problem. Right. And for the 7-unit building, it ended up not being the end of the world, because when I bought that property, the roof was sort of on its last legs, and I was planning, I'd already underwritten that I would have to replace that one in the near term. And I was actually able to get a little bit of insurance proceeds that I probably wouldn't have otherwise gotten on that one to do so. But the other, the duplex, from the inspection, I was not anticipating to have to replace it out of the gate, but I did. As much of a journey as it was to negotiate with insurance companies in one of the most litigious states in America, I ended up walking away a little bit out of pocket, but not totally scarred. I think the bigger long-term issue for Florida and other states prone to natural disasters is just how is the insurance market going to play out? I mean, Florida has had a bit of an insurance price crisis over the past 2 years since Ian, in that owners' insurance premiums have doubled or tripled in some cases, right?
Is that your experience?
It was my experience that the 7-unit policy probably close to triple, but that's not really an apples to apples comparison because the actual coverage expansion increased after we put on that new roof. But it was certainly like it was a huge increase. And now I say, Texas, I don't like the property taxes. Florida, I don't like the insurance. So pick your poison.
Yeah.
Which one's worse? Or find a state that doesn't have either as a problem.
Yeah, that's why I'm looking at Kansas City, Missouri. The property tax, my property tax on the property I was looking at was like $1,500. Right.
For how big of a house? How valuable of a house?
1,200 square foot bungalow, 152,000.
Sounds pretty good to me.
Yeah, off market. Rents for 1,300. Yeah.
Purchase price?
152.
Yeah, so you're almost at that 1% rule.
Mm-hmm. There is a small rental, probably like 20. But again, I really like the economic fundamentals of Kansas City, Missouri. But 5.9% cap rate, so that factors in insurance and property tax.
No, I mean that's probably about as good as you're gonna do on a single family house, I would think. I mean, I was shooting
sevens.
more for the.
We have clients getting 7s in Memphis, Tennessee.
Interesting.
Yeah.
Okay.
A bit older house though. It's like 1950s house or 1960s, so a bit older. But yeah.
Very good.
So, would you do these Florida properties again?
I go back and forth on that one, right? I mean, there's obvious reasons to say no, I would never want to do it again, but there are also some reasons to say it was a good learning experience. I developed a very good relationship with this community bank. I was able to on the 7-unit one, right? It was actually both of them really treated more like a commercial loan, and so it was actually a pretty easy approval process.
Mm-hmm.
I've got fairly low rate fixed term debt for some time. It's being amortized over a 25-year period, so a good chunk of principal has already been paid down. And I guess, I'm still looking at everything from a portfolio-wide picture, in that over time, this will hopefully deleverage, free up equity, or just continue to deleverage to get to the point that rental income or a portion of it turns into free cash flow. I mean, the one thing that the Florida properties got me that the Texas and certainly the Ontario properties did not was the best rent to price ratio. So, I mean, if we look across the portfolio now, I was just doing quick math before I came here. Gross rents across, 13 units in 6 separate properties in 3 states or provinces are about 28,000 Canadian. Now, a good chunk of that is in US dollars, so that number is going to go up and down with the exchange rate. But if I can just sort of let these ride and pay themselves down, that's $336,000 a year in gross rents in today's dollars. If I can optimize operating expenses to be about 50% of that, then what's that? $168,000 a year. I would be quite happy with that if we can just eventually get them paid off over the next, 15, 20, 25 years.
And what do you think? You planning on any future investments? What do you think your next investment will be?
I actually think right now my most rational move is to just sort of wait, sit back, deleverage, right? When I talked about optimal capital structure earlier, I went from having arguably not enough debt on the portfolio in 2021, whatever that was, to, some might argue, the upper boundary of enough or perhaps even too much. So I think, well, the curious side of me loves looking at properties, looking at new markets, going on Zillow. The rational CPA side of my brain says probably the best move at this point is to just throw some excess cash flow at a couple of the loans underpinning everything and freeing up equity, freeing up cash flow. Because at this point, do I really need to take on that much more risk in my life? The answer is probably not, to get to my goals, but it all depends on what every individual's goals are, right? I mean, I sort of have an idea in my mind of what I would like my portfolio to be in, say, the next 15 or so years. I can probably cut it off at this point and just let the loans pay down, maybe accelerate the pay down of some of them, and continue to allocate other money to stocks and bonds as a traditional investing approach as well. But we'll see. Ask me in a couple of years and see if I stick to that, because I think I probably said that in 2022, and look what happened.
I know it's not exciting for the listeners' benefit, is because we have lots of guests who come on and just grow and grow and grow. But then, there's a whole bunch of people losing their shirts because they grew into areas during a bad time to grow. Now, my question would be, if you were in buy mode, where would you invest?
So, because I haven't been in buy mode for a couple of years now, on either side of the border, I don't know that I'm the best person to really even give an opinion on this, but I guess I can give my 10 cent or 2 cent opinion. But I mean, if we just think at a high level for your listeners, particularly looking at the US, you've got the Midwestern markets, like the St. Louis, or sorry, was it Kansas City or St. Louis?
It was Kansas City, Missouri.
Okay, sorry.
The Carolinas.
Yeah, right. So you've got Kansas City, St. Louis, other Midwestern markets are probably going to have better cap rates, higher cash flow out of the gate. Do they have as much appreciation potential as a DFW? I honestly don't know the answer to that question, just because I haven't researched those markets enough to really know. Obviously, Texas I already talked about. I do think the economic fundamentals are there, but the property taxes, unfortunately, just kill the numbers on a lot of deals. Florida, I'm in no rush to deploy any more money into after the somewhat scarring experience. The Carolinas have actually been interesting to me because, just from very anecdotal small sample sizes, when I look at rent to price ratios on Zillow while I'm lying on the couch, it seems like Charlotte, for example, North Carolina, would be a market that would tick a lot of boxes for me, and you could probably make a deal work. What I don't know is just, I haven't done enough research really on it to.
Happy to share mine with you.
Sorry?
I'm happy to share mine with you.
Okay, well, you can share yours in a minute, but you're still gonna get a little bit of the hurricane risk, I suppose, but not nearly to the extent that Florida would. So that's probably my piece on the Carolinas. So I think Charlotte could be a viable option if I were to get back in the game, but who knows when that'll be and what will have changed. But what's your thesis on the Carolinas?
Yeah, because I was looking at a deal in Savannah and the insurance wasn't that bad.
Okay.
Savannah's coastal, right? So a lot of the Carolinas are coastal as well. Then if you are looking at the Carolinas, then you probably want to look near where Toyota is building their next plant. It's a $14 billion investment. Probably create somewhere around 5,000 or 8,000 new manufacturing jobs. So anyone who knows like Honda and Alliston or like Toyota and Cambridge knows what that did to their markets. Or,
Right, and
Woodstock, Ontario.
What part of what city is that in?
I have it in my spreadsheet. But,
Okay.
Yeah, happy to share it with you later. And then Ozempic, the company that manufactures
Yes.
Ozempic, has a $4 billion investment, and I think also in North Carolina, $4 billion investment to create 1,000 manufacturing jobs. And I've heard good things about it. The weight loss drug.
Oh, yes.
Oh, you're not.
Well, no, I wasn't sure if you were like, I've heard good things about the drug itself,
Yeah.
or the manufactured facility where they're making it. I just, the way it came out was kind of entertaining.
This is not my field. But again, I have friends in the training space with patients, and apparently it works well. And you know, you offer weight loss in anywhere in North America, if it works.
There's a very high uptake on it in the United States, anecdotally, I believe. And I mean, the commercials are catchy, right? So.
I had no idea what it was, but man, they had a lot of money. I think they had Super Bowl commercials for Ozempic.
Probably, yeah.
Right. But then to my point, you don't see this investment in Canada. You don't see an automotive manufacturer putting up 14 billion. You don't see a drug manufacturer putting up 4 billion, right? And those two alone are in the Carolinas.
Okay, yeah, no, that would be intriguing for sure.
Yeah. All right. Any final thoughts for the listener? Like, you're still a young guy, and a lot of our listeners are around your age.
Yeah, no, I guess if I were just to sort of summarize some of the things some of the themes that we've touched on today. The first one would be time, right? Whether we're valuing a stock, or we're valuing an option, or we're thinking about investing in real estate, or we're thinking about investing in the form of a small business, I would argue that time is actually probably one of the most, if not the most, variables that can set us up for success, right? As I said before, I let time do a lot of the heavy lifting in my own real estate investing. I hope to continue to be able to do that, to your point on age. And so, there's that saying, when you're investing in stocks, time in the market is more important than trying to time the market. And I think the same is also true in real estate as well. So, regardless of which asset class you're looking at, the longer your time horizon, statistically speaking, the better your chances of success. So that would be one. Number two, I probably sound like a broken record, but that business valuation concept of optimal capital structure, thinking about debt as a tool that can be used responsibly to grow. I mean, I certainly would not be in the position that I'm in had I not taken advantage of debt when it was relatively inexpensive. And I mean, I get that we're sort of in a completely different era now, and things are harder, and maybe that means that buying with less leverage is the more prudent option than it was, say 2, 3, 4 years ago. But at some point, you can calibrate things to make the math work. And if you're in a financial position where you have sort of enough cushion to absorb any blows that come your way, like a hurricane in Florida, for example, you're obviously in a much better spot. And so there is a reason that I hit the pause button for about 10 years before I got back into things. A third would be, I guess, if you're going to, well, invest in anything really, but invest in real estate, invest in stocks, being willing to sort of embrace risk and give yourself permission to make some mistakes. If you buy a property, I don't care if it's the best property, the worst property. What I can guarantee you is you will probably look back at some point in your investing career and say, oh, I made a mistake here. And if you beat yourself up over it, you're just sort of diminishing your chances of long-term success. And I'll give you an example here. One being that Hamilton Mountain House. I think it was not too long, maybe a year in, the roof on that one went. I mean, we'd done the inspection. I thought it would hold up for maybe another 5 years or so, but sometimes inspections, things don't go according to plan, even compared to an inspection. And so it sucked. I mean, that probably killed the cash flow on that property for that year.
Mm-hmm. Mm-hmm.
And having come from, an academic and then a corporate environment where we were sort of rewarded for perfection and for not making mistakes, it took me a bit of time to embrace more of a risk mindset and live through that and say, okay, well, this didn't work out according to plan. Is it going to kill me in the long term? And after I was able to get over that psychological hurdle and think back to that first variable I mentioned, which is time, I realized a little bit of short-term pain doesn't change the game plan. And that's how I'm looking at Florida as well right now, right? If I had looked at that new roof in 2013 for the Hamilton Mountain House and let that deter me from investing, and I simply said, oh, on a cash-on-cash basis, this year was rough, so I'm just going to sell the mountain house and redeploy the capital into stocks, I'm quite confident I would be kicking myself in 2024. Now, I'm not expecting that the next 11 years are going to be like the past 11 years, but I do think that having some willingness to make mistakes and learn from them was something that I sort of had to learn as an otherwise fairly perfectionist type person.
And then very young at the time.
Yeah, and I guess that sort of leads into my last point too, which is just having realistic expectations for people getting started. I mean, if you're buying your first investment property in 2024 and you're listening to this, and then 2034 rolls around and you look at that house or that whatever piece of property that you bought and it hasn't doubled or tripled in value, you should not consider that a failed investment, right? The tailwinds that we had, as we've discussed, for the past 15 years, or at least as long as I've been owning property, it's easy to say, oh, of course this worked out because you bought in 2009 or 2012. And you would be right. Like, it makes it look easier than it actually is. Real estate investing has some hard moments to it. And so I would just encourage people starting to invest to sort of level set their expectations and give themselves enough time so that they can achieve that 5.5% sort of long run, and it truly needs to be long run in order to have a good likelihood of achieving that.
Because I've shown you this chart before. If you work at the stock number, which is the big performer, it works out to just over 10.5%,
right,
including dividends for the S&P 500.
Okay.
So, like a leveraged example of leveraged real estate would beat that quite easily.
Yeah, you'd be in probably the low 20% range. Maybe less than that if you're a Canadian buying in the US and only getting 70% loan to value. But yeah, somewhere, 22%, maybe even 25% if you're lucky. 18% if you're not using as much leverage, which would probably be the case in today's environment for U.S. property, certainly.
But we're also not including mortgage pay down
Right.
or cash flow.
Exactly. This is just the dessert piece that I talked about
Yeah,
earlier.
the dessert piece, which we're very happy to consume.
Yeah, it's taste of dessert, but
Oh yeah.
as you eat your cookie.
That's what makes us rich, right? All right, Adam, thanks so much for doing this. I think I've been bugging you for a while to come on the show.
I think you have. No, this was fun. It was good to be here.
Mm-hmm.
Hopefully the audience can take something away from this. But I genuinely am a student of this stuff and love talking about this sort of stuff. So it's been fun.
Where can people follow your journey? Should we give them your website?
Yeah.
LinkedIn?
I mean, yeah. You can sort of find my contact info on my website. It's synthesisvaluations.com. I don't know if you have show notes or something you can put that
Yeah,
in.
we'll put in the show notes, yeah.
And then you can also find me on LinkedIn as well.
If they just search Adam R. Johnson, they'll find you?
Adam N. Johnson. In
N.
fact, I think if you go to linkedin.ca/Adam N. Johnson, see what pops up. No, not the English football player.
It looks just like you.
He's also a convicted felon, I believe.
Oh, gee. Is that our problem at the airport?
No, well, no. I have an access card, but
3,100 Adam Johnsons in LinkedIn.
try doing Adam Johnson. CA, CFA, CBV.
Oh yeah, those are unique identifiers.
There you go.
Look at all those letters. I'll have the links in the show notes. Adam Johnson, CPA, CA, CBV, CFA.
That's
So
the one.
you've proven you're smart.
I hope so.
And then I guess you just done well both in real estate and business.
If you say so, sure. Yeah.
I don't know the numbers, but you would.
No, I mean, I'm sort of happy with what I have built, right? I mean, real estate investing is sort of one piece of it. Running my consulting advisory business is the other piece of it. But I think between the two, I can hopefully, over the long term, build my own destiny. And that was sort of the catalyst for all of it, right?
Yeah, including quitting your day job. And I remember the day you told me you're quitting your day job. And
yeah, that was
Working
8
on
years
your
ago. That was 8 years ago. And it's been a fun 8 years.
that's why I was wanting to pull you on the show. Like, real estate gave you the freedom, gave you the working capital to take that leap.
It did, yeah. In that sense, that mountain house has been the gift that has continued to give because it funded the creation of the valuation firm and it continued to fund the U.S. purchases down the road. So lucky, perhaps, yes, but there's that saying, I'd rather be lucky than good any day of the week. And if you can be lucky and also try to be good, make smart decisions, take some lumps, but still try to minimize your mistakes, then that's sort of the best case scenario.
Never heard the definition of luck being the intersection between opportunity and being prepared.
Something like that, yes.
Yeah. All right, we'll leave it there. Thanks so much for doing this, Adam.
You're very welcome. Good to see you.
Thank you for watching. If you want to learn how to invest in real estate from scratch, my team teaches beginners how to use the #1 investment strategy that I personally use in a virtual free training class every month. Go to investortraining.ca/YouTube to register for our next class. The link's also in the description as well. I publish at least 2 to 3 videos a week here, so subscribe if you want to keep learning from seasoned investors like myself and my guests. And if you're just starting out, feel free to ask questions and comment below, and I do the best to answer each of those comments and questions myself. Again, if you're ready to learn the nitty-gritty about real estate investing from a professional investor, register for our next virtual class. That's at investortraining.ca/YouTube. Thanks again for watching. See you in the next video.